The AI bubble is growing, and it's not just a tech hype cycle, it's reshaping the S&P 500 and putting your retirement savings at risk. In 2026, over 45% of the S&P 500's market cap is tied to AI stocks, and many are trading at valuations that don't match their current performance. This isn't just speculation, it's a potential market crash waiting to happen. Are you prepared for the fallout? Let's dive in and find out how you can protect your investments before it's too late. What if the AI boom turns into a bust? That's exactly what we're about to explore. The S&P 500, the benchmark for US equities, is now heavily skewed toward AI stocks. The top 10 stocks in the index account for over 40% of the market, with AI companies playing a major role. This isn't just a trend, it's a shift in the very structure of the index. When you look at the companies driving this growth, you'll find heavyweights like Nvidia and Microsoft, both of which are at the forefront of AI innovation. Their stock prices have soared, but this growth may not be sustainable. The problem is, when a small number of companies control such a large portion of the market, the entire index becomes more vulnerable to downturns in those specific sectors. Think about it. If one of these AI leaders faces a regulatory issue or a slowdown in demand, how much could that ripple through the broader market?
It's not that AI isn't valuable. It's transformative, after all. But when it's dominating the index to this extent, it raises concerns about market stability. And let's be honest, even the most optimistic forecasts can't account for everything. So what does this mean for investors? It means the risk is higher than it used to be. And that's something to keep in mind as we move forward. Many AI stocks are trading at valuations that may not be justified by their current earnings or growth prospects. It's not just about what these companies are doing today, it's about how much investors are willing to pay for the potential of what they might become. Take a look at the price-to-earnings ratios for some of the biggest names in AI. For example, some of these companies are trading at PE ratios that are well above the historical average for the S&P 500. That means investors are paying a lot more for each dollar of earnings than they have in the past.
This kind of valuation isn't typical in a stable market. It suggests that the market is pricing in future growth that may not yet materialize. When companies are valued based on potential rather than performance, it can signal a speculative bubble. A bubble forms when investors are buying assets not because they're fundamentally sound, but because they expect others to pay even more later. It's a cycle of rising prices driven by hype rather than actual results. Goldman Sachs has been one of the few voices warning that the AI boom may not be sustainable. Their analysis suggests that while the technology is promising, the current market enthusiasm might be overreaching. They're pointing out that the rapid rise in AI stock prices could lead to a correction if the underlying fundamentals don't support those valuations. This isn't just a prediction, it's a cautionary note for investors who are caught up in the excitement. So what does that mean for you? If the hype fades and the market corrects, the value of these stocks could drop sharply. That would mean a significant loss for investors who have overexposed themselves to AI stocks.
It's not just about the companies themselves, it's about the entire ecosystem of investors who are betting on the future of AI without a clear path to profitability.
Wait, really? If the AI market is overvalued, what happens when the hype fades? The answer could be a sharp drop in stock prices, which would impact investors who have overexposed themselves to AI stocks. That's a lot to consider, especially if you're holding a large portion of your portfolio in these companies. It's not just about the numbers, it's about the reality of what those numbers mean for your investments. And that's why it's so important to stay informed and think critically about where your money is going. As AI becomes more integrated into everyday life, regulatory scrutiny is increasing. Governments and institutions are examining the ethical and societal implications of AI, which could lead to new regulations that impact the industry. Data privacy and algorithmic bias are becoming major concerns, which could affect the long-term viability of AI companies. The European Union has already introduced strict regulations on AI, and similar measures are being considered in the US. Regulatory scrutiny is increasing as governments and institutions examine the ethical and societal implications of AI. Wait, really? If regulations become stricter, could AI companies face higher costs or even be banned in certain areas? This uncertainty could reduce their profitability and stock value. Think about it. When a government decides to regulate an industry, it often means that the industry has grown beyond its current oversight. For AI, this could mean additional compliance costs, slower innovation cycles, or even restrictions on how AI is used in critical sectors like healthcare, finance, or law. And that's totally normal. Regulation is part of the process when technology outpaces policy. But here's the thing. If AI companies are suddenly forced to spend more on compliance, their margins could shrink. That could translate into lower profits, which would impact stock prices. So while AI is still a game changer, the regulatory landscape is a wild card that investors can't ignore. The question is, how prepared are you for the rules of the road in this new era of tech? Many 401k plans are heavily invested in index funds like the S&P 500, which are now overexposed to AI stocks. This means that retirees and investors are at greater risk if the AI bubble bursts. The volatility of the AI-driven rally could erode retirement savings and impact long-term financial goals. Imagine a scenario where the AI market crashes, not just a small dip, but a sharp decline. If a 401k is heavily weighted toward AI stocks, the value could drop significantly. It's like putting all your eggs in one basket, and that basket just shattered. The fact is, many 401k plans are tied to index funds that are now leaning too heavily on AI companies. Wait, really? If the AI market crashes, how much could retirees lose? The answer could be a substantial portion of their retirement savings, the kind of loss that could jeopardize their financial security. Think about it. If you're relying on those funds to cover healthcare, housing, and daily expenses in your later years, a big drop could mean a big setback. This isn't just about market fluctuations. It's about the long-term stability of your future. And that's why understanding the risks of overexposure is so important. Because when the bubble pops, the consequences could be far more personal than you might expect. The AI-driven rally has led to high volatility in the stock market. That's not just a fancy term. It means the value of stocks is swinging wildly up and down, and it's happening faster than ever before. And for retirees and people who rely on their 401k or IRA to make ends meet, that kind of volatility is a real problem. Think about it. If your retirement savings are mostly in the S&P 500, and the S&P 500 is now heavily weighted toward AI stocks, then when the market takes a sudden turn, your savings could take a hit too. A sharp drop in AI stock prices, even a few percentage points, could cause a significant decline in the value of a 401k portfolio that's too concentrated in AI. Let me break that down. If, say, 45% of the S&P 500 is tied to AI companies, and those companies suddenly face a correction or a slowdown in growth, the whole index could lose value. And that means your retirement account, which is invested in that index, could lose value too. It's not just about the numbers, it's about the timing. Retirees often don't have the luxury of time to recover from a market downturn, so the risk is even higher. Defined contribution plans like 401ks are vulnerable to market downturns, making diversification and risk management critical. That's a key point. These accounts are designed to grow over time, but they're also exposed to the same market risks as any other investment. If the AI bubble bursts and the market crashes, those accounts could lose a lot of value, and fast. It's like putting all your eggs in one basket. Only that basket is made of tech stocks. So what can retirees do? Well, the answer lies in diversification and careful asset allocation. Diversification means spreading your investments across different sectors and asset classes, not just stocks, but also bonds, real estate, and even international markets. By doing this, you're less likely to suffer a significant loss if one sector crashes. For example, if AI stocks drop, a well-diversified portfolio might still hold value in other areas, like healthcare or utilities. But diversification alone isn't enough. You also need to think about how you're investing. If your 401k is too heavily weighted toward the S&P 500, you're taking on more risk than you might be comfortable with. That's why it's so important to review your investments regularly and make sure they align with your financial goals and risk tolerance. And remember, the goal isn't to avoid risk entirely, it's to manage it smartly. Because in a market that's growing more volatile by the day, that's the only way to protect your retirement savings. So if you're worried about the AI bubble and how it could hurt your investments, the first step is to diversify. That means spreading your money across different sectors and asset classes instead of putting too much in AI stocks. Think of it like not putting all your eggs in one basket. If one basket falls, the others might still hold up. Real estate, commodities, and international stocks are all solid options that can help balance out the risks. Diversification isn't just about avoiding losses. It's about making sure your portfolio grows steadily over time. If the AI market takes a hit, having other investments can cushion the blow. For example, if you're holding a mix of stocks, bonds, and real estate, a downturn in tech might not wipe out your entire portfolio. But here's the twist. Diversifying doesn't mean you have to stop investing in AI altogether. It's about balancing your bets. You can still keep a portion in AI if you believe in the long-term potential, but don't let it dominate your holdings. And let's be real, the market is always going to have ups and downs. But by spreading your investments, you're less likely to suffer a significant loss if one sector crashes. This is a key strategy for protecting your retirement savings and making sure your money works for you, no matter what the market does. So take a step back, look at your portfolio, and ask yourself, am I truly diversified? Rebalancing your portfolio at least annually is a simple yet powerful way to maintain your desired asset allocation. Over time, certain assets can grow faster than others, shifting your portfolio away from its original risk level. By rebalancing, you bring it back in line with your financial goals and risk tolerance. It's like a checkup for your investments, ensuring everything's working as intended. And the twist? This practice doesn't just help you stay on track, it can also protect you from market volatility. Tax-advantaged accounts like IRAs and 401ks add another layer of protection. These accounts offer tax benefits that can shield your savings from market downturns. When you contribute to a 401k or IRA, you're not just reducing your taxable income, you're also locking in a portion of your savings that's less exposed to market fluctuations. This is especially important for retirees or those nearing retirement who may not have the time to recover from a sudden drop in value. Let's be clear, rebalancing and using tax-advantaged accounts aren't just strategies, they're tools that help you navigate uncertainty. If the AI bubble deflates, having a diversified portfolio and a portion of your savings in tax-protected accounts can make all the difference. It's not about avoiding risk entirely, it's about managing it smartly. And that, my friend, is how you build long-term financial security. Because the goal isn't to outsmart the market, it's to stay steady, even when the market wobbles. Takeaway: the AI bubble poses significant risks to both individual investors and retirement accounts. Action: diversify your portfolio, rebalance regularly, and use tax-advantaged accounts to protect your savings. Diversification helps spread risk across different sectors and asset classes, so no single area can tank your whole portfolio. Rebalancing ensures your investments stay aligned with your goals, even as markets shift. And tax-advantaged accounts like IRAs and 401ks shield your savings from market volatility. Remember, the goal isn't to avoid risk entirely, it's to manage it smartly. If you're unsure how to proceed, consider consulting a financial advisor who can help you tailor an investment strategy that aligns with your goals and risk tolerance. Let me know in the comments what steps you're taking to protect your investments from the AI bubble. After all, the best way to prepare for a storm is to build a strong, diversified shelter.